When I discovered the stock market, I pretty much immediately fell in love. And over the last 3 years, I've done nothing but study economics and trading strategy in hopes that one day I would become a professional day trader. I scraped together a little bit of money to help me get started. You can see that balance here. As you can tell, it's not really that big of a balance, and if I want to make it as a professional trader, it's going to have to get a lot bigger. The question is, how much bigger is it going to have to get? Well, given that the minimum wage in this country is roughly about $15 an hour, depending on what state you're in. The state I'm in, it is. If you work 40 hours a week, 52 weeks a year, that will give you a salary of about $31,200 a year. Now, as a trader, you don't have the same 52 weeks or the same number of working days as possible. You have 252 trading days a year. So if I take $31,200 and divide it by $252, that means I need to hit about $125 a day in order to take a salary. I'm writing about this journey and I'm talking about it here in the Russel Journal. My name is Russell, and this is my journal entry for today, November 1st, 2022. It is Tuesday. Today, there's some stuff around some economic data out of Texas. The industrials were down, everything of that nature. Overall, everybody's waiting on a few numbers. The first set of numbers that we're waiting for tomorrow, the end of FOMC meeting, where the Fed will tell us what the interest rate hike is. Pretty much most everybody's money is on 75 basis points, and the real question isn't whether or not we're going to get 75 basis points or not. We all pretty well know we're going to get another 75 basis points. So what are we worried about? The stock market, isn't okay. What we don't know is what the next interest rate hike will be, okay? There seems to be some disagreement as to what will happen. Now, there are those who just think that December's next rate hike will be another 75 basis points. There are those that think that December's next rate hike will be only 50 basis points. And there are a few people out there who believe that the Fed will start to pause their rate hikes in December. What we have and what we know from the Fed is that Powell is not interested in pausing the rate hikes until basically until the inflation has been abated. Now, if that is the truth, if that's the case, where he will try and be is data dependent, or that's what they're saying that they're going to be data dependent, right? And so if they're going to try and be data dependent, they're basically waiting until they see CPI numbers start coming down before they start to pause. Well, the last CPI report we got had the core inflation at 6.6%. The one before that was at 6.3%. So we're seeing a continued rise in inflation. If you've watched much of what's going on this channel, the thing that you'll need to realize about whatever's happening as far as that goes, the Fed raising rates is continuing the rise in inflation. That's what's happening. They're not actually, at the moment, reducing inflation with rate hikes. What you need to see in order for those rate hikes to end is you have to see the inflation, or you have to see sales, retail sales, and earnings come down. I don't know if you're around for the last few earnings reports. They weren't great, but they definitely weren't collapse worthy either, right? You don't have like sales absolutely tanking if you pay anything attention to the last earnings reports. So what does this really mean for the future of the market and for the future of the market? Well, that's the multi-billion-dollar question. What does this mean for the future of the market? We have no clue. So I have no answers for you. I thought the market was going to price things in. I thought they were going to operate and assume that the cost of money is getting near stability or starting to stabilize. but we haven't really seen any of that. So we're going to head and go to the charts, and we'll look and see what is sort of setting up. Now, mostly the thing I will tell you on the charts when we go into them today, a lot of what you're going to see is a bit of a lie. Tomorrow is going to pretty much rock the whole world of the whole chart, of the charts, and I honestly, you can't make any decisions. If you're going to try and capitalize on this market behind us, you have to do exactly what I am doing over here, okay? Over here on my chart, or on my trade setup, I have put on what's called a strangle, okay? Now, I'm really close to the money on the short side. I'm way far out of the money on the long side. In the event that things are good, the market says, hey, we've priced all this in, that call will pay big. Big, big, big. On the short side, in the event that the market says, hey, screw you, man, we didn't know any of this stuff, and now we got to price a bunch of stuff in, that put right there right now will simply cover the cost of the call. Okay? Now, the good news is call expires like in 2 weeks, but the put is expiring tomorrow. So we will see what the volatility does and how well this strangle works out. Now, I haven't updated the actual account balance, what I did in money today, because of this strangle and because of FOMC. So check in tomorrow and I'll let you know kind of how things played out. In the event that the call gets paid for, I can just hold it for 2 weeks. I'll be fine with that. Like, no big deal there. I may be able to sell it because it does expire like a week from Friday. So I might even be able to capitalize on, takes back some of my capital, and we'll be okay. In the event that the market likes what we hear, or they like that the Fed is being dovish, we'll just cut the put and we'll go cash in on the call. You know, we'll get the long side of it. So right now it's a bit of a risk-free trade for me as far as it goes. The balance. I think you can see over here, I'm green like $30 on the call, and I'm down 100 on the put, or I'm green at $30 on the put, and I'm down 100 on the call. Anyway, so getting into the chart, right? And again, this whole thing again is going to be a bit of a lie, right? You don't really know anything. They've really got it set up in no man's land. We're looking at SPY. You are in the uptrend, but as you can see. And we're on a shorter time frame here. As you can see down here, down, I'll walk over here, down here to the slow stochastic. Our momentum is down, and it's losing momentum on a lot of different longer time frames. I was hoping on the monthly chart. So you can see from the monthly chart here, we had this big green candle last month. The S&P, the Dow, all the indexes put in probably the best month they've had in quite literally decades. I think 1976 was the last time it had a month that good. Unfortunately, it was that good in this downtrend. Okay, right here. So it's not great. What I was hoping for was that this green candle right here was going to bring this momentum way up. Okay. We did not get that. We did get momentum is definitely curling up from the oversold position. So the explosive move that I was really hoping for back up to the 18-month moving average has not transpired, and everything's on edge because we don't actually know. And again, something I talked about yesterday was the fact that whole setup could be wrong. That's why I waited today. I grabbed my strangle going into the rest of the day, just in the chances that it does blow up in my face. I've got some security there in order to save the old account. So, all right, let's go ahead and jump over to the daily chart and take a look at what's going on there. Okay, so we can see on the chart, okay, you can see that the momentum is up, you're still embedded, the trend is up, the bias is up, okay? So this does mean that we're still long biased. We're still wanting to buy calls more than we're wanting to buy puts. However, Okay, a few things are interesting here. The fact that you got to like the 6-day moving average at the low here, and you didn't get any pushback from that, that's bad. The other thing about it is, if you look at these 3 candles here, you've got this big green candle, then you have this little tiny doge inside of this green candle. That's called an inside candle or an inside day. Okay, and usually what that one particular candle, as first of all, as this kind of doge, this is a evening star. This is called an evening star reversal. Okay, where you have on both sides of it, you have this big green candle, you have the red doge right there, and then you have the other longer body red candle right behind it. Okay, this is typically seen as a reversal of trend. Okay. So again, reasons to be short or to at least have some sort of insurance on the chart, that is a reason why you buy a put. Part of the reason we bought this particular put is because it was very close to the money that we were at. In the event that we crash, we are covered, and we're covered quick. We get fast cash this way, and to hold for the call, right? Now, going forward, not only do we have FOMC this week, we get the big unemployment data, yay, on Friday. Last month it was right around 3%, but we haven't really seen that much growth in unemployment. It's all been roughly the same. We follow it every week. So I don't know what sort of surprise they're hoping to get for October's actual unemployment rate for the whole month, but I guarantee you it's still going to look pretty good. You got Christmas coming, you got seasonal jobs coming, you got guys going from working at the swimming pool to working at the ski hill. I have friends that work in ski hills. Shout out to my guys, by the way. Anyway, so I really, it's anybody's guess as to what to happen. What I can tell you is the move off of this is going to be explosive, okay? You're either going to get a rocket to the bottom, or you're going to get that rocket to the top, like we talked about yesterday. When, how, where, I don't know. But the one good thing about this short position is if we do just absolutely tank tomorrow off of that, I will be able to get my money back for my call, and I'll be able to essentially cash that out immediately, okay? And then we can reposition to a longer term short position at some point. And do it a little more safely. Right now, this is not super safe, given that the last 2 days have really you've been stuck between basically 384 and that upper Bollinger Band at 390, and for the bulk of the time, I know this if you go back to this red candle here, it looks big, like this happened all day long. And the truth of the matter is it went down in like the first 30 minutes of trading to like 384 and just stayed there the rest of the day. So that's also not good for the call position, by the way. When we closed in the lower quadrant of the range. So if you don't have put positions on, to be honest with you, if you don't have a position on at this point, you should not have a position on. FOMC comes out at 2 o'clock Eastern Standard Time tomorrow. It'll be about, I believe that's 11 o'clock here on the West Coast. So don't put anything on. Don't try and trade FOMC now. It's especially don't try and hedge now. And when after the meeting happens, you'll see, if you've never traded a meeting before, you'll see a couple of really crazy moves. And this happens every single time. There will be a huge $4 or $5 1 minute candle one direction, and then there'll be another huge $4 or $5 candle in the other direction. So this seriously, every FOMC meeting it happens. I will tell you, little word to the wise, the first move off of an FOMC announcement is usually a fake out. Okay, most of the time. Go back to August. You can go look on the day they have the Jackson Hole meeting. Big spike up, crashed the whole market there. It was a 4% move to the downside right after that. Same thing with this last FOMC meeting. One spike up, just completely crashed after that. So, and that was another like 4 or 5% move. So we'll see if Powell pulls the rug on everybody tomorrow or not. Either way, I'm feeling pretty good about it. Worst comes to worst, we'll break even on this thing. So, anyway, thanks for coming. Thanks for checking out the video. Please make sure to hit that like and subscribe button. The Russell Journal is written, edited, and hosted by me, Russell. We are produced by Social Media Shows. My executive producer is Maria Pereza. So more details about her in the description down below and about Social Media Shows. Also go to the website, check them out. They can help you produce a show just like this, like I'm doing. Anyway, and until tomorrow, just pretend I said some sort of catchphrase.